Welcome back. Now in the previous videos, we looked at the income statement and the balance sheet. Now these provide us measures of a company's success in terms of performance. Essentially by looking at the income statement, you see what was the net profit or net loss of the company during the period. So this is a measure of the company's performance. By looking at the balance sheet, you get to see what the company has achieved over the period of its existence. So by looking at the balance sheet, you can have a fair knowledge of the financial position of the company. Now cash flow statement is another important component of the financial statements. Cash flow statement, as the name suggests, tells you about the flow of cash to and from the company. So essentially through a cash flow statement, the company discloses the sources and uses of cash. So by looking at the cash flow statement, you can say that from where the company received all its cash during the period, and you can also tell how it deployed this cash over the period. When a company discloses the sources and uses of cash, it helps the creditors, investors, and anyone who is looking at the company in evaluating the company's solvency, liquidity, and overall financial flexibility. When we say financial flexibility, we mean the ability of the company to adapt and react to financial adversities and opportunities. A cash flow statement essentially classifies all cash flows to the company or from the company into three categories. These categories are the operating activities, investing activities, and the financing activities. Let's start with the bottommost activity. Cash flow from financing activities are cash flows from activities related to obtaining or repaying capital to be used in the business. So financing activities include obtaining or repaying capital such as equity and long-term debt. The two primary sources of capital are shareholders and creditors. So cash inflows includes cash receipts from issuing stock or bonds. So whenever the company issues a stock or a bond, it receives a cash inflow in exchange. On the other hand, cash outflows include cash payments to repurchase stock or to repay bonds and other borrowings. The next important category of cash flow is cash flow from investing activities. Now cash flow from investing activities includes purchasing and selling long-term assets and other investments. These long-term investments include property, plant and equipment, intangible assets, or other long-term assets, and both long-term and short-term investments in equity and debt issued by other companies. Cash inflows in investing activity includes cash receipts from sale of non-trading securities, property, plant and machinery, intangibles and other long-term assets. Cash outflows include cash payments for the purchase of these assets. So for example, when you buy a machinery, there would be a cash outflow. So this would be a part of your cash flow from investing activities and it will be a cash outflow. Similarly, if the company were to sell a property, then it will receive cash in exchange of selling that property. So this will be part of cash inflow from investing activity. Then lastly, you have cash flow from operating activities. These are activities not classified as either investing activity or financing activity, and they generally involve cash effects of transaction that determine net income, and hence they arise from day-to-day operations of the company. So all your cash flows which arise from day-to-day operations of the company are classified as cash flow from operating activities. The cash effects of these transactions directly determine your net income of the company. Hence operating activities include the company's day-to-day activities that create revenues such as selling inventory or providing services. Also any other activity that cannot be classified as investing or financing forms part of your cash flow from operating activity. In general, the cash inflows as part of operating activity results from cash sales and from collection of accounts receivable. Similarly, cash outflows which form part of cash flow from operating activity result from cash payments for inventory or payment for salaries, taxes, and other operating related expenses. Cash outflows under operating activity may also result from paying your accounts payable. Now let's look at an example of a cash flow statement. Here is the V group cash flow statement. It starts with the profit before tax of 1261 million. Then you subtract the actual income tax payments and then adjust this amount for effect of non-cash transactions, accruals and deferrals and transactions of financing and investing nature to arrive at the amount of cash generated from operating activities. This amount is 12,741 million. The way the statement is shown here is known as the indirect way of cash flow reporting, because what you do is you start with the profit before tax and you adjust this amount for effect of non-cash transactions to arrive at the amount of cash generated from operating activities. There is another way of reporting cash flow statement known as the direct reporting, which we are not covering for now. Now the indirect method emphasizes different perspectives of income statement and cash flow statement. On income statement, income is reported when the income is earned and not necessarily when cash is received. Similarly, expenses are reported when incurred and not when actual payment is made. So for example, if you made a sale to a customer and delivered the goods, then you would recognize this income as part of your income statement, but the customer may not immediately make payment to you. So the date on which the cash is received for this sale may be different from the date on which you recognize the income on your income statement. Similarly, in case of expenses, the expenses are reported when they are incurred and not when the actual payment is made. So for example, if you received certain goods, you know that you have an obligation to pay to your supplier or the vendor, but you might not make this payment immediately. So the date on which this expense is accounted for in your income statement might be different, while you might make an actual payment on a different date. The cash flow statement presents another way to look at the performance of the company. Specifically, it tells you about the ability of a company to generate cash flow from running its business. This is essentially the part of your cash flow from operation. This number tells you how much cash the company is generating from running its business. Ideally, an established company should generate most of its cash flow from its operating activities rather than generating cash flows from investing or financing activities. When you sum up the net cash flow from operating activities, investing activities, and financing activities, after taking into account the effect of exchange rates on cash, the sum of all these cash flows essentially equals the net change in cash during the fiscal year. So for example, in case of V Group, the sum of these items is 8,792 million in 2009. Since this is a positive amount, it results in an increase in cash for the V Group at the end of the period. To keep things simple, we are not covering other details of cash flow statement for now. In the next lecture, we are going to look at another component of financial statement, which is the financial notes and supplementary schedules.